Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. Interest in Penn National Gaming surged amongst financial pros this week 873%. And this comes off the back of the company's recent earnings release on February 3rd. While earnings missed by more than 50%, revenue came in slightly ahead. Yet, the stock barely budged, which is rather unusual. Normally, we'd expect shares to face heavy selling pressure. Yet, they've actually climbed since earnings. And that got us curious, since shares are down more than 65% from their all-time highs in 2021. As we explored Penn's business, from its gaming properties to its partnership with Barstool Sports, we found something rather interesting. Penn National Gaming made headlines back in February 2020 when it entered into a strategic partnership with Barstool Sports, who agreed to exclusively promote Penn's land-based and online casinos and sports betting products, including the Barstool Sportsbook mobile app. Traditional gaming such as slots only goes so far. Online gaming is a booming business with a younger demographic. Furthermore, it starts Penn down a digital road that creates multiple complementary channels to engage and retain customers. Lastly, we want to highlight the company's recent acquisition of Score Media and Gaming Inc. The $2 billion acquisition gives Penn a digital sports and media app with news and content to complement the current digital strategy. Moving to the financials, like most businesses, Penn took a hit in 2020 from COVID. Since then, both revenues and margins have recovered nicely. And we should note that the company has $2.7 billion in cash on hand compared to long-term debt of $2.65 billion and leases of $8.67 billion. But with nearly $300 million in cash from operations each quarter, we don't see debt as a major burden. Moving to valuations, this was quite challenging given their adjusted earnings calculations. However, as we looked at the valuation metrics at face value, they looked pretty decent. Price-to-earnings ratios aren't great, especially looking forward. However, 23x isn't terrible either, nor are the price-to-sales ratios all that lucrative. But the price-to-cash flows looks pretty decent. Yet the growth numbers are what really tells the story here. With revenue growth of 65% year over year and forward growth of almost 23% on sales and EBITDA, we get a clearer picture of what's going on here. Penn is building out its business through technology and integrated operations. That takes some time, but once completed, it can pay huge dividends. In our opinion, this is an 8 out of 10 ranking stock, and the financial pros got it right on this one. Penn has a solid business and plan to create additional income sources through sports betting and digital media. We like how they have multiple channels that complement each other. Ideally, we'd like to get shares below $40, but that's more of a wish than a requirement. Click and subscribe to the Spill newsletter to get the full breakdown.